Hey everybody, welcome back to Investing with Wesley. Today's episode, I want to talk about lending and I want to talk about inflation and what happens to your debt in the event that inflation gets so bad that we see hyperinflation happen. But before we get to what happens to your debt in a hyperinflation situation, we first have to talk about the structure and how lending actually works from the lender's perspective and the borrower's perspective. So with that being said, let's get into it. Okay, so how does lending work? Well, lending works in an obvious sense of someone borrowing money from someone else, whether that someone else is a bank or another individual. Either way, one person is temporarily giving another person some money for a certain amount of time it takes to get paid back. Lending is not free because there is a risk to the lender that they won't get paid back. So they have to be compensated for that risk. And on top of being compensated for the risk of not being paid back, they also have to be compensated for tying up their money, lending it to you instead of some other asset that could produce a profit. So there is the risk compensation and the compensation of spending power that that person or bank is giving up by loaning you the money. This is why banks and lending in general is charged an interest rate as a compensation for the risk that they're taking in loaning you money. Okay, so that is the simplest version of how lending works and why the interest rates are what they are. Now let's talk about the different kinds of interest rates, because everyone knows there's variable interest like credit cards and there's fixed interest like mortgages, but everything works very differently. As an example, a variable interest mortgage like a credit card, those by most people's standards are considered bad debts that no one should be in, because as interest rates rise further and further and further, because inflation is rising further and further and further, your payments continuously have to go up and up and up until they basically become so unaffordable that you end up defaulting. This is why credit cards are the bane of every financial advisor. Every financial advisor like Dave Ramsey will tell you to get rid of your credit card debt as quickly as humanly possible. And that is completely true. In a hyperinflation situation, there is only one way out of credit card debt, and that is to default. If you can't get your credit card debt under control and pay it off immediately, in a hyperinflation kind of environment, the only solution is to default and in a sense go bankrupt. But the reason credit card interest rates is as high as it is, upwards of 20%, is because it is unsecured debt. In the event that you don't pay, then the lender is just out money. They don't get anything. There isn't a tangible thing like a car or a house that they can repossess and at least have something of value to compensate them. Because it's an unsecured line of debt means that the compensation for the risk that the lender is taking goes up and up and up, and it goes up on top of whatever the baseline, which is the Fed funds rate interest rate is. So as regular interest rates continue to rise, so does the interest rates that you'll have to pay on your credit cards. That's why it's variable interest rates and really bad. But even though people like Dave Ramsey and all his followers will disagree with this, there is actually something that is called good debt. And good debt is great when it comes to a hyperinflationary environment. Good debt is actually a wealth transfer from the lender to the borrower when done properly. And what I mean by that is really exactly as it sounds. There's no hidden meaning. When using debt properly, you can transfer wealth from the lender to the borrower, and it makes it even better in a hyperinflationary environment. So let me explain. There's different kinds of fixed loans out there. You can get a fixed loan on a car or a TV or a motorcycle or something like that, or you can get a fixed loan on a mortgage like a house. So what are the differences, and are all fixed loans good debts? Well, I'm sure you're smart enough to know that buying a new vehicle with a fixed loan that's a depreciating asset, meaning it goes down in value over time, is probably not a good debt or not a smart thing to do. However, this is where in a hyperinflationary environment, it's not so much a bad thing. Remember, hyperinflation is the excessive printing of money, of currencies. And although it takes a while to filter through the system and hit wages, wages do always go up. It may not happen as fast as asset prices like the stock market. It may not happen as fast as the economy and businesses, have record profits. But as inflation takes a toll, as businesses get more and more profitable because the prices keep going up, people will eventually demand more money for the labor that it takes to make those businesses profitable, and eventually there is a trickle down of wages going up. So in a hyperinflationary environment, wages go up drastically because of how much money there is in the system. And even though you made a bad purchase buying a new vehicle or a motorcycle or a TV or what have you, because it is a fixed amount of debt and a fixed amount of interest, no matter what the interest rate skyrockets to, you are only obligated to pay back the agreed upon number and the agreed upon amount of interest. So although right now it could take you an entire year to make $50,000, in a hyperinflationary environment where wages also skyrocket, it could only take you perhaps 1 month to make $50,000. Now, that's not to say that you're just going to be rich beyond your wildest dreams, because if you look at Zimbabwe, the prices of everything had gone up that drastically as well. So although you'll still be realistically spending the same amount of money when it comes to value, the amount of money you owe back to this particular bank for whatever you bought months or years prior, that is the same amount. So it's become that much easier to attain those dollars to pay back that loan. And that is where fixed debts in a hyperinflationary environment really benefits, because you may not make money, but it becomes extremely easier to pay off that loan because of how much more dollars there are in circulation. Now, the coup de grace of good debt is not purchasing a depreciating asset, but purchasing a cash flowing, appreciating asset with debt. Because in this sense, this is the true wealth transfer when it comes to lender to borrower. You can get a fixed interest rate mortgage at whatever the interest rates are set at right now and buy a rental property, buy a cash flowing asset. You purchase that asset continues to go up in value because it's linked to asset prices, which always benefit during inflation. The fact that you're using debt to purchase this home makes it easier to pay off as the money supply expands, and if you're using it as a rental, you can have someone else's money supply paying off your debt to begin with. So you hit all three benefits that make this particular investment of a rental property an amazing thing to do when you're working with debt in an inflationary environment. Okay, so we know how lending works, and we know how the different forms of debt would work in a hyperinflationary environment, but what happens to your debt in the event that a currency collapse happens? There's one of two options that can happen. The first one is that all debt stays denominated in that currency, and in a sense, you could take $1 worth of the new currency at whatever that exchange rate is, convert it into the old dollars, and pay off the loan that way. Or the next option, although completely unlikely, is that your debt gets recalculated and exchanged into the new currency units, and you're obligated to pay that debt back. Now, although you're probably thinking to yourself that that's more likely because the government and banks are going to want their money, and that is true, the reason it probably won't happen is because the biggest borrower of money out there is the United States federal government. So for them to create a new currency and then obligate the people who borrow money to pay back all those old debts in the new currency wouldn't make sense, because they'd be setting themselves up for failure. And in the event of an inflationary crisis when it comes to the dollar, it would probably be because they couldn't afford to pay back those debts to begin with. So in reality, they're not going to make the same mistake and force all the borrowers to pay back the debts. It would probably be option number one, which is to just have everyone exchange into the new currencies, the old currencies become completely worthless, and although you would still owe that debt, it would become extremely easy to pay that debt off. You may only need $1 or $2 of the new currency units to pay your entire mortgage off. And this is why whenever me or anyone on YouTube talks about the end of fiat currencies, it is never a deflationary death spiral, but it is always the end of currency in an inflationary way. Because historically, going all the way back to the beginning of time, that is how every single currency has died. It has been in an inflationary manner, whether it is the Romans secretly putting other metals into their gold coins to expand the money supply that way, to the point where people found out about this and devalued the Roman coin completely, or modern day Zimbabwe, Venezuela printing fiat currencies to the point where a loaf of bread costs $2 trillion. Either way, the result is the same, an inflationary death to the currency that can only end in one way, and that is all your debts being basically completely forgiven because no one wants that currency anymore anyway. Sure, you'd still owe the bank $200,000 or $300,000 for your mortgage, but the bank will no longer be running off of US dollars, and they'll no longer be caring whether you pay them US dollars or not, because to them it'll be completely worthless. I hope you got value in this video. If you did, please remember to like and subscribe, as it really helps this channel get out there. This may be confusing for a lot of people, so if you have any questions, comments, or concerns, feel free to message me on either Facebook, Twitter, Instagram, or just leave a comment down below. Either way though, the choice is yours, and I'll see you in the next episode.